In this week's mortgage rates and housing market update, we've got local stats showing inventory continues to remain stagnant while more homes continue flying off the market. Then, in local stories, it appears that Lehigh Acres may be making some strides towards a comeback and a potential opportunity for long term investors and aspiring homeowners who are looking for some of the last remaining affordable housing in Southwest Florida. And finally, we'll break down the Fed's latest meeting and several other macro stories and what those are indicating for the future of housing. That's coming up right now. Welcome back. I'm Rick Harrison with MVP Realty in Southwest Florida, and in this week's housing market update, we'll look at what the market conditions are shaping up to be as we continue into 2022, as well as several stories suggesting Lehigh Acres may become an opportunity for investors and homeowners in the very near future. But first, if you haven't already done so, please make sure to hit that thumbs up button to support the channel and help me continue sharing this information with others like you thinking of moving to Southwest Florida. And don't forget to subscribe to stay up to date on the information like this, as well as the latest tips, tools, and resources to help you make better decisions about buying, selling, and investing in real estate. All right, now let's dive on into this week's market data. All right, so for this week, for our 7-day market update, we're taking a look at the stats actually from last week, not from 2 weeks ago. And I'm sorry about not having posted last week. I was up in Connecticut. I had a death in the family. But this week I am back and I have the updated stats for this week as compared to last week's stats. So for new listings, we went down 5%. That was from 664 last week to 637 this week. Again, same trends we were seeing. We're hovering right around the mid 600 range as far as inventory for new listings coming on every 7 days. Solds are up 5%. They went from 621 last week to 651 this week. So that is also, again, we're netting a total net of 10% down week over week from last week. And then also pendings, those are up quite a bit, up 10% from 1161 last week to 1281 this week. That again is just showing that more houses are, more of our inventory is going off of the market than is coming on. And that's just continuing trends as we've been seeing since the beginning of the pandemic. So moving on, we're going into total inventory breakdown. Single families last week, as of last week, there was 1,995 single family homes on the market. This week, we're down to 1,876. So that's a loss of 119 single family homes. Condos, we went from 814 last week up to 825 this week. So that's a gain of 11. So the total there between single families and condos, which, as I said before, condos does represent townhomes, condos, mobile homes, all of those different properties outside of the single family, outside of single family homes. So total is a net loss of 108 units over this past week as compared to the week before. Moving on to multifamilies. We are in 80s, so that's a good range. We went from last week being at 80 multifamily properties on the market to 86 this week, so that's up 6. That's a good news because we've been seeing that was hovering right around 70 for quite a while. So from compared to 2 weeks ago and 2.5 weeks ago, we're up about 16 or so new multifamily properties on the market, which is good news. Rentals, again, this is a continuing trend. More rentals are coming on the market. We're going to take a look at a story later on that's going to probably have a little bit of an explanation as to why more and more rental properties seem to be coming on the market. But that last week we're at 3,655. This week we're up to 3,689. That's a positive gain of 34. So between multifamilies and rentals, we're up 40 more additional units. So that's welcome news there. Interest rates for 131. Last week's interest rates, according to NerdWallet, 3.455%. That is up for the 30-year fixed mortgage, up to 3.514% this week. So that's up an additional 6 percentage points or basis points. Bank rate has that average going from 3.67% last week to 3.74% this week. So we are now starting to get closer to a 4% interest rate on average, according to bank rate. All right, let's go right into I have a lot of stories today, some local, some macro. So let's go right into it. We're going to do a 5-minute local updates. Just real quick, Southwest Florida led state with incoming migration. So this report actually has Collier County ranking number 3 with a 9.7% rise in inflow versus outflow ratios. So that means we have more people coming into Collier County than leaving by almost 10%, which is quite significant. And that just goes to prove, along with the rest of the rankings, we had Hendry County, which is not too far away. They're up to 10.8%. That was the actual first place in the state of Florida with the highest amount of influx for migration coming in versus going out. And then in second was the Highlands at 10.7%, which that includes places like Lake Placid, Sebring, Avon Park, and Venus. 4, 5, 6, 7, 8, 9, and 10 on the market on the list. Indian River at 9% for number 4. Number 5 was Charlotte County, which is right above us, right above Lee County, 8.1%. Right above that is Sarasota County at number 6 with a 7.3% increase. And then we have Bay, home of Panama City, Sumter, home of the Villages, which is at 6.6%. St. Lucie, 6.2%, and then Lee County, which is our county that we are in currently, coming in at number 10 at 6% influx versus what's going out. So for those of you who are wondering what's going on with the market, that is why inventory continues to decline. More people are moving here just to the state of Florida in general, but Southwest Florida is the leading area for that influx of people with Collier County, which is Naples, leading the way at number 1. Lead Port Authority gets the go-ahead to develop 1,150 acres, which is going to be a large development. That is welcome news for those of you who do not know where that area is. The Lead Port Authority is out near 82, right between Fort Myers and Lehigh Acres. So Lehigh Acres actually has 3 local stories in here that are actually positive news to hear. Which is suggesting, like I said earlier, suggesting that Lehigh Acres might be a very good opportunity in the very near future for investments, as well as those who are looking to find affordable homes. It's still an affordable area to live when compared to the rest of the counties around us. But these new stories are actually giving Lehigh Acres some positive traction. So the commercial development foreseen by Lee County and Port Authority officials is part of an effort beyond shops and stores to bring commercial enterprises that will be hiring people who live locally or who are relocating to Southwest Florida. It's an initiative to move some of our job growth north. Most of our job growth in Lee County and even Collier has been in the southern parts. Just as you move down towards Estero Bonita, you have a lot of malls and a lot more shopping centers down 41, all the way through into Naples. Now, with this new project coming about and being approved, this is going to start moving some of our job growth and some industries into the northern parts of the Fort Myers area. Also, duplex homes back on track in Lehigh. So we got 2 stories here. So duplexes went away for a while as far as the popularity, but those are coming back. And then we also have 120 home development coming to the Fort Myers Shores area. So the multifamily duplex and attached 2-family homes are going to be going onto a 3.04 acre site that's in the shape of an L. So it'll be actually 10 different sites that are all right next to each other. They're all zoned and now are being rezoned, which is good news because that's going to be opening up a little bit of a precedence for some of these potential single-family areas to be rezoned, which would allow builders to come in now and start building more homes and properties. Again, the other story here is there's going to be a 120 dwelling complex on Orange River Boulevard in Fort Myers Shores. There's a huge tract of land, as you can see from the picture in that below, and that was agricultural land. It is going to be was actually considered one-time automobile junkyard and some agricultural land, and now that is going to be changing, where they're going to be looking to develop another 120 dwellings on that area. So again, and then the third and final real story for Lehigh is Richard Young, who is a student at Lehigh High School. He is bringing in some really big names in the football. He's been drawing in Nick Saban, Kirby Smart, Ryan Day, Billy Napier. That was all over 24 hours about a week and a half ago, with actually the championship coach coming in on a helicopter. Kirby Smart landed at Lehigh Acres and got all kinds of attention. Obviously, at this point, he can't talk to any of the recruits, but he did meet with the coaches, and that's good news, and that's bringing some positive traction to Lehigh Acres High School as well. All right, moving into the 5-minute macro. So the Fed meeting, they did have a meeting just this past Wednesday, and I was a little bit disappointed. I'll go over why, but we're going to take a quick listen to what Powell had to say during his meeting. But then also we're going to talk about the housing market. So let's get right into that. So I was a little bit disappointed with the meeting because the federal chairman, Powell, really did not disclose any new information. He just basically said that we're sticking to our original plan to start decreasing the bond purchases that we've been doing. And then we are also still looking at interest rate hikes beginning potentially in March. But let's take a look at what the federal chair had to say. And it's just, he gets asked a lot of specific questions and he really comes out and says, look, we don't know. And that's pretty much how the whole conference goes. But let's just take a look. He kind of stumbles over some of the questions and what his stance is on certain things.
So I'm afraid to tell you that those are all great questions, and they're questions that the committee is just turning to now. So we had a discussion, as you know, at the last meeting, an introductory discussion of the balance sheet and a teeing up of the issues. At this meeting, we've gone through and carefully put together a set of principles at a high level, and those are meant to guide the actual decisions we'll make about the pace and about all of the questions that you're asking. And I expect that this process will be something that we spend time on in coming meetings. I can't tell you how many, I can't tell you how long it will take, and then, at the appropriate time, we'll provide additional information. In terms of what we've seen, I would say this, we said at our last meeting, we published a summary of economic projections, the median participant expected 3 rate increases this year. And, it's 6 weeks, 7 weeks later now. And you have seen that our communication channel with the markets is working. Markets are now pricing in a number of rate increases. Surveys show that market participants are expecting a balance sheet runoff to begin, at the appropriate time, sometime later this year, perhaps. We haven't made that decision yet. So we feel like the communications we have with market participants and with the general public are working.
So there you have it. As I said, he didn't really give us any new information. He was a little hesitant on, answering quite a few of the questions and really seemed to avoid a lot of the answers to the questions that were posed to him. But let's move on. Housing industry. So the housing industry, there's the thing I want to show in today's episode is that there's really two sides of this, and I want to show both sides because people really don't know what's going to happen with the housing market, and that's very evident from just these two stories alone. But the first one is the housing industry insider warns the market is looking into the teeth of a storm. So home builder confidence for new homes dropped 1 point in January. Data shows, I think we're probably going to see that drop again in when we come out with the new stats in February. But this particular insider is saying that our cost of labor has gone up 8% year over year, which I'm sure is not surprising to anybody who's looked into new construction homes. And now with inflation, interest rates going up, he thinks that this is going to make things worse, which I agree. And then on top of that, on top of just the labor going up 8% year over year, components for building and appliances costs have gone up 21% year over year. Anybody who's already built a new construction home probably has seen those appliances rise, as well as now we're expecting 8 to 10 month delay for appliance orders. And that's pretty typical right now. So even if you think that building might be the better way to go, you can expect to see delays on when your home will be completed just simply because of appliances and the back orders on all of the materials, the labor materials, the building materials, as well as the appliances. Now we have on the other side of the coin, we have another story that is saying that home price growth is decelerating, which I believe, and I've been saying for quite a few months now, is going to happen one way or the other. It has to with the interest rates that will be increasing soon. And I know a lot of people say that the Fed's interest rates don't necessarily correlate to the mortgage interest rates, but they already are. So whether they rise another 0.25% to get us to that 4% as we saw in the most recent interest rates, I think they're already pricing in right now for interest rate hikes. Goldman Sachs, Bank of America came out and said up to 7, which I think is a bit high, but we really don't know. And this story is saying that the deceleration has already started to take place. And that CoreLogic's, some of the predictions that are coming out now are quite a bit milder as far as what the home price growth will be. So just to put it in perspective, last 12 months, we've seen an 18.8% on average price growth in homes over the last 12 months. Zillow is still coming in. They're the highest. They're predicting 11% growth increase this year alone. And then we have some of the lesser but still more aggressive predictions. Fannie Mae coming in at 8.4%, Freddie Mac at 6%, and then we have the less aggressive, which would be Redfin at 3%, Realtor.com at 2.9%, CoreLogic at 2.8%, and the MBA at 2.3%, which was the lowest. The thing here is, for those of you who have been watching for a while now, Zillow, as we all know, they have a ton of data at hand because they collect most of the data from a lot of the MLSs across the board. Now, with that being said, they also have shown us that they aren't the greatest at analyzing that data and using it to their benefit, because they did use this at a point in time to purchase homes in bulk and purchase above asking price in the market, and they had to shut that down. We don't really know exactly why, but I'm assuming it's because they started to realize that their predictions were not going to be helping them make any money, and actually instead cost them quite a bit of money. So because they're coming in at 11%, I don't put any weight into that. I hold it with with a grain of salt. And I think that the lower numbers are actually going to be much closer to what actually happens, just because the market sentiment has already started to change. And you can see that in the stock market as well as home buyers. They're just waiting. And I don't blame them. So here's a chart, U.S. home price growth from 2001. So you can see where we hit obviously the housing market crash in 2008, and you can see that the home price growth was negative. And now we are at the peak. We've never been higher as in these terms. This is the S&P CoreLogic Case-Shiller home price index. But as you can see, if you take a close look, the last 3 to 4 months, you can see that the price growth has already started to decline. And in this next one, you can see where CoreLogic puts their price prediction towards the end of the year. It'll be actually about a 2.8% growth forecast year over year. And then just another article right from NBC News. So what to expect from the housing market now that the Fed has announced and that they will be signaling the rate hikes beginning in March, potentially, and most likely. CNBC is saying that home sellers need to realize that the days of double-digit price appreciation are over. So if you are a seller, it's still possible right now to get some pretty good appreciation rates from before the Fed does make these moves. But in the future, in the very near future, you're not going to be looking at these kinds of appreciation. So if you are thinking of selling, this is kind of that turning point where the market is starting to shift a bit. You're seeing the signs coming out. You're seeing the warnings coming out from all kinds of industrial experts. So my recommendation would be, if you are looking to sell, that you do it soon while you can take advantage of this. The other side of that is when you're at this point, you're kind of on the knife's edge where it's starting to roll over the other way. You're going to be able to, on the other side, make out with, if you do have to rent for a little while at a higher price, you might be able to get the other side of this where prices start to slow down quite a bit and the demand is not there because the rate increases have started. So buyer demand is going to be lower, which means you're not going to be competing against other buyers in as top of market. So you won't be seeing as many, best and final or multiple offer situations happening, which could be good for you as a seller and a buyer. The other thing to note that I thought was noteworthy in that article was that it notes that we're getting close to a point where 1 in 5 homes is essentially being taken off the market, off the home ownership market for rent. So a lot of people that have come into the market in the past year and a half to 2 years have been investors, and not just, individual investors or syndicates, but really large corporate investors like BlackRock. And you can see that directly from the market stories where Zillow closed down their iBuying programs and ended up selling a majority of their home purchases back to BlackRock, which has started to become, a huge mover in the market in the housing industry. They're gobbling up all kinds of homes right now, and that's unfortunately affecting the homeowners out there who are looking for homes to live in. So I think this is going to be a big part of what we see to come in the near future with the housing market, and that's just going to keep it's just going to keep going that way. Which means that at some point, if government does end up stepping in, they're probably going to be looking at putting caps on rent. So if you are an investor, think about that and start pricing that stuff into your deals, whatever you're looking at, because if they're going to be putting caps on your rates, you're going to need to price that in before they do it, because if you don't and you're below market value and you get capped out, you're only going to be able to do, about 3% rate increases each year. And if you're well below market value, I understand wanting to provide affordable housing to people, but at the same time, as an investor, from an investment standpoint, you really should bring your rates up to market rate, what the market's actually getting for them right now, so that you don't get limited on what you can raise your rates later on when it's too late. Next story, Jeremy Grantham, who is a very well-known investor and has been very accurate with most of his predictions as far as bubbles and crashes. He's predicting now. He was a little bit dovish earlier in the bubble, or what they're calling now a bubble, but earlier in the pandemic. He's now predicting a crash of 43% off of what we've already seen. So, we've already seen 10% decreases in the last 2 weeks over the market. He's expecting that this trend is going to go down to, you're looking at the market to hit 2,500, which will be way down, and it's about 43% as he is predicting. These are just some highlights from his interview, but just some things that he's looking at. The global housing problem that's causing enormous pain. You have a stock market bubble that seems similar to 2000, or he feels is similar to 2000. You're seeing overpriced commodities. Oil's at $88. And then you have the lowest real rates in the history of man. And I mean, we could go lower. We could go in a negative, but it's the lowest it's ever been. It's practically zero. So, and anytime, if you look back in the markets, anytime the Feds have started to increase the Fed rates, you see that we enter a recession. And unfortunately, we're at a point where we really don't have anywhere else to go. Like I said, we're at zero already. We could go negative, but as soon as they begin to increase those rates, it's most likely going to put us into some type of a recession. He also goes on to say that everywhere else is less overpriced than the U.S., which is the peak of this bubble, as it was in 2000 with the dot-com bubble. And that what that meant is that it will, and what it will mean today is that the U.S. will decline a whole lot more than the rest. And at the same time, if we do increase our interest rates here, it's going to affect most of the other countries who are on the dollar. So they're already at low interest rates, and if we increase our interest rates, it's going to make it less affordable for those companies to get imports from us. And then also the peak of crazy behavior is behind us. We're now in the buy the dip mode, which anybody who watches YouTube and watches the stock gurus, especially the crypto gurus, buy the dip. I've been listening to people saying that for months and months now, and I just keep watching it go down and down and down. And now you're starting to see some of these bigger YouTube gurus. I won't mention any names, but there are several of them out there who have now reversed their course after they've cost all of their viewers, the millions of viewers that they have, continually telling them to buy the dip. They cost them so much money. It's kind of funny actually reading it's sad, but at the same time, it's funny reading these comments when anybody who's listened to them and was buying the dip, they're just going based off of this person's recommendation, and they really don't have any idea what's going on in the market. So that's unfortunate, but Grantham is now saying that we're in that peak. We're over that. We're now seeing the buy the dip, which is why the stock market, and like a bear stock market would, it's going to decrease. And then you're going to see gains where people buy the dip because they feel it's been oversold. So you're going to see an increase, and then it's going to go down again. And that's what a bear market looks like. Most people haven't been, at least in our age bracket, have not been through a bear market, a real bear market. But that is what the trends tend to be. And I think that's what we're going to continue seeing for quite some time. And then this, I just thought, I go on the subreddit sometimes and I look at Wall Street bets, and I found this picture and I thought it was apropos. 2008 versus 2022, and you can see this S&P 500 ETF. The market looks very similar to what it did in 2008. Not that the market situation is the same, but the market looks the same as far as the trend lines on the market charts. So that wraps it up for this week. This week's market update. Thanks for watching, and if you enjoyed this video, please hit that thumbs up button to let me know. And don't forget to register on my site to get access to loads of exclusive tools, data, and content like foreclosure and open house lists, buyer and seller guides, calculators, and access to our Southwest Florida MLS. If you have any questions, please don't hesitate to give me a call or send me a text at 239-310-5478. And if you prefer email, you can send one to rick@swflrelocationteam.com. Thanks again for watching to the end, and I hope to see you next week.